Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
All right, let's get to the jobs report this morning. Traders slashing their bets on the pace of future Federal Reserve interest rate cuts after that September U.S. employment data blew past estimates and signaled a robust hiring trend. U.S. job growth, folks, last month topping all estimates. The unemployment rate unexpectedly declined and wage growth accelerated, reducing the odds, as we said, that the Fed will opt for another big interest rate cut in November. Talk about another reset.
Federal Reserve Bank of Chicago President Austin Goolsbee praised the strong September jobs report. He warned, though, of putting too much stock in 1 month's data. He spoke earlier with Bloomberg's Michael McKee.
This jobs number today and the whole report is a superb report. You really couldn't ask realistically for a better report. I still think as a central bank, you don't want to react too much to 1 month's report.
That, of course, is Chicago Fed Bank President, Austin Goolsbee. Let's get more on that U.S. jobs report and the U.S. rates trade, because we certainly have seen some moves. With us is Bloomberg News International Economics and Policy Correspondent Michael McKee, along with Bloomberg News rates reporter Michael Mackenzie, both here in studio. Mike, you like baseball? Holy cow.
Which Mike?
Mike McKee.
Do you like baseball too, Michael Mackenzie?
I do, actually.
Okay.
Oh, okay.
All right, there you go. No, I was asking, the phrase that went through my head this morning as soon as the number came up was the old Phil Rizzuto phrase, holy cow, with his accent in his head, because this was such a surprise to everybody. The 154,000...
I know, holy cow.
The holy cow number we got this morning was just kind of unbelievable. And so... with 254,000 jobs created and 72,000 additional jobs found in the revisions, nobody had that on
What
their,
are we missing? What did
scorecard.
economists miss?
We don't know.
Huh.
It's really hard to pull something out of this because the household numbers were really strong too. 430,000 jobs created in the household survey.
Yeah.
And a lot of jobs in the household survey, 281,000 was the number of unemployed that went away. They didn't have more unemployed. They had fewer unemployed.
Yeah.
So just about everything you looked at in this report was better than the last time. I mean, it sums up, some down, but was better. The 3-decimal unemployment rate, we went to 4.1. But if you go out to 3 decimals, it was 4.051. So basically 0.06 you would have had a 4% round. So that would have been even more gobsmacking than what we got.
Austin Goolsbee, when you spoke to Michael McKee, he said you don't want to put too much stock in 1 month's data. Michael Mackenzie, come on in here, because it does seem like rates traders are sort of tearing up their bets that we're going to see some big cuts in the next few months as a result of this report.
Well, we've been here before. So we had a big rally end of last year into early this year, and then we got some resiliency in the economy, upside inflation. Of course, we get inflation coming next week. And we'd had a great 5-month run here in Treasuries over the summer, which matched the best run we'd seen since, I think, 2010. So the market was due for some consolidation, but this is definitely a shock because, you know, as Mike's explained, it was strong across the board.
Yeah.
Upward revisions for past months, so you can't cling to that and say, oh, maybe this number's a bit too over the skis here. Unemployment rate dropping, but wages picking up. And wages are picking up at a time when no one expected that in the bond market. You've got CPI coming next week, but I think also, look at oil prices. We're up like $7 in the last week or so. China's announced a massive stimulus, and that's helping put a floor now under commodity prices more broadly, and sort of, you know, downplaying concerns about China exporting deflation across the global economy from here. So the bond market's going to have to reprice and kind of now have to say, look, the Fed told us that they were really focused on labor. Now we have to start, if labor's doing all right, now you've got to keep an eye on the inflation side of the dual mandate. And that's not looking so hot here, too, because there's stuff coming along, these shocks. So
there's only two things to keep track of, Carol. I don't understand why it's so tough.
Well, exactly.
Just two things on the
Two
plate.
things at this moment. Who knows by Monday?
Just inflation in the labor market.
That's it.
Well, Austin Goolsbee did say to you that there are risks that inflation might undershoot the central bank's 2% target. I mean, I'm a little confused because I also thought in the last Fed meeting that Jay Powell still said we're still above their inflation target. So
well,
he's
they're above
keeping an
their
eye on
inflation
it.
target, but the way the trend is going, if you extrapolate out, 3-month annualized month-over-month change is 1.3%. So, I mean, nobody thinks that's going to continue at that rate, but
Yeah.
if it did, then the Fed's got a problem on the other side. Mike's right. We've got to watch these other indicators. September, probably too early to see an inflation thing. As people say, inflation causes wages, not wages cause inflation. And in this case, the fact that wages are up is probably a reflection of a tighter labor market and the composition of the wage gains, although they were fairly good across the board. So it may not show up yet,
Right.
but it's something that the Fed does have to keep an eye on.
Well, Michael Mackenzie, as you did in your report today on the Bloomberg terminal, you did say it's a pattern we've seen before. So some weak data could ratchet up, again, bets on more Fed easing this year. So when you look at the 10-year, we got so close to 4%, right? We didn't pierce it today.
getting there.
Are we thinking that, though, we could go above 4% again?
Yes.
Are we okay.
I think there is. People will stay in the front end because the Fed is still going to be easing.
We're so tight.
Yeah. And therefore, we've sort of aligned better more with the dot plot, which is what the Fed's outlook they told us last month's meeting. They want to do 2 more cuts this year. And if you look at rate cuts all the way through to next March, the bond market is now pricing less than 425 cuts. So the bond market's in line. So for the near term. And so there will continue to be volatility around the rate cut bet type outlook.
Very quickly, 20 seconds, your next focal point that you think we should all keep an eye on.
CPI next Thursday, with perhaps the meeting minutes released on Wednesday also being some fodder for traders to look at.
Same thing for you.
Yeah, same thing. We'll see what the Fed officials were talking about at their meeting, what they thought was going to happen, and then we'll get a CPI report, and that'll give us something to trade on, if nothing else.
Michael McKee, International Economics and Policy Correspondent here at Bloomberg News, and our Bloomberg News rates reporter, Michael Mackenzie, both here in studio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, let's talk a little bit more about the monthly jobs report, which we know showed more hiring. We just talked about it with Michael Mackenzie. Michael McKee showed more hiring and less firing. Job growth topping all estimates that we surveyed here at Bloomberg. And the unemployment rate, Tim, unexpectedly declining. And we saw, of course, wage growth accelerated. As Mike said, holy cow, because it was just like every metric was a positive one.
Yeah, nobody got that right. For more color on the employment picture, let's head on over to Amy Glaser. She's Senior Vice President at the Global Recruiter Adecco. She joins us from Florida this afternoon. A really strong report, and I'm wondering, Amy, if this is what you expected. Pretty much no economists who were surveyed by Bloomberg actually expected this. But I'm wondering, given the data that you have, what you see day in and day out from your customers, was this a surprise to you?
Well, I think we spoke about this last month as well. This is a reflection of the September surge. Every time this time of year, we see seasonal hiring gets ready, hospitality, leisure picks up, the healthcare industry remains white hot. So frankly, I wasn't surprised. I think it's the September surge. We should see positivity again in October and November. And for the rest of the year, the market remains resilient.
All right. So having said that, I am curious in terms of digging down into your data. You guys see an awful lot. How much of it is part-time? How much of it is full-time?
We see a mix and combination of both. You know, one of the interesting nuances right now is that the worker really does want flexibility and part-time work. So the numbers, whether it's part-time or full-time, are really a reflection of what the job seeker is looking for, more so even than what the company is putting out there. So we see a mix. We see continued increase in part-time work, flexible work schedules, hybrid remote schedules. Flexibility is key right now.
Amy, are employers in the driver's seat or employees in the driver's seat?
I think it's a mix of both, and it depends on industry and it depends on geography. We are starting to see a little bit of a shift. It had been such a candidate-driven market for the last 4 years, and we are starting to see that really actually become more of a balance. Again, depending on if you're a travel nurse, you're still in the jobs hot seat there. So it really depends by industry.
Wait, so in terms of, is there any trends you can tell us about, like it's tech that's hiring, it's healthcare that's hiring, or what types of jobs are really in demand right now?
Yeah, absolutely. Healthcare is hiring. It will continue to. We see home healthcare being a big need. I mean, we talk about the peak 65 phenomenon. More people retiring every day in the US than in history, and we're going to continue to see needs in the healthcare industry. Hospitality and leisure have picked up. Starting within the next couple of weeks, we're going to see a big, huge uptick in transportation, warehousing, customer services, as folks really get ready for that holiday hiring time of year.
Right.
So just all over the board.
We just talked to Amazon actually about their hiring needs. We did that, I think it was yesterday, right? Yeah, in terms of pretty much on par with what they did last year.
250,000 temporary workers.
Yeah,
on the more
ready.
than 1 million workers they have already.
Right.
I'm wondering, Amy, where you're seeing weakness here. Where specifically are you seeing weakness? And I'm not talking sector-wise. I want to know geographically where you're seeing weakness.
Well, right now with the devastation in the Southeast because of Hurricane Helene, we're going to have a difficult road over the next couple of months.
Is that already showing up in your data?
It is. It is.
How so?
We're seeing, obviously, manufacturing has been impacted. We've got some supply chain issues going on. Even the average, worker, we have folks still trapped, unable to even get to work if their facility is open. And I think it's going to be a lasting, months before we see a full recovery in some of those locations.
I do want to get to what you said. I don't know that we call it the aging of the workforce. Folks kind of getting to their point where they're retiring, leaving the workforce. It's something you guys have been focusing on, specifically how employers are navigating up to 5 generations of talent in the workforce. But talk to us about the older folks who are leaving, because for a while I felt like we were talking about, because of a shortage of workers, some older workers staying in longer, needing to stay in longer, wanting to stay in longer, or employers needed to them. Tell us about that and what impact that will have longer term on some of the trends when it comes to employment.
So our data right now is showing that about 1 in every 6 retirees is actively seeking to return to the workforce, whether it be for a sense of purpose or community or a fellowship with others. There's a strong appetite for them to return and have that true sense of purpose. Now, oftentimes it's in a part-time capacity, and we're seeing manufacturing take the best use of it and really helping upskill and reskill that new generation. It's a trend we're going to continue to see. And although we'll see more retire this year, I think we'll see a resurgence in the years to come as they have a little break and a vacation and then come back and re-enter the workforce part-time.
Amy, you mentioned sense of purpose. You mentioned sense of community. One thing you didn't mention was them going back to work as a result of necessity and needing to, because they can't actually survive in retirement on what they saved and what the government provides. Is that an issue too?
It's one of the many factors as well. I mean, inflation caused more to return. So we'll continue to see that, and whether they want additional spending money or to supplement in areas where they may simply not have enough, it will continue to be a factor.
I mean, you guys are massive. You're global. You see so much. Anything in the data, because what's interesting is, and I heard a really important conversation this morning on surveillance with Claudia Sahm, who obviously watches the labor market to get an idea in terms of, I guess, recessionary indications, but saying that, well, the job market looks really strong. It's 1 month of data, very strong. Not everybody is feeling that strength. Not everybody is employed. Not everybody feels like they're in a job that is certainly paying all their bills. So I just wonder what you guys see more broadly. Does it say that it's a healthy economy globally, healthy economy in the U.S.? The numbers say one thing, but I am curious if you see some things kind of behind the data points.
I'm not an economist, but I do see the labor market right now is strong. It is resilient. There are job opportunities. It may just be a mismatch, though. There's still more than one job for every job seeker available out there, but do their skills, do their location, do their wants and needs actually match? So I think it is a strong market. We just may still have a balancing issue between the talent and those hiring.
So what skills would you suggest at this point?
So employers are really focused on soft skills and things that can't be taught. So communication, flexibility, the ability to work in a team, the ability to work autonomously or take direction. I think it's really those soft skills that are going to set folks apart. And if you're looking for a job right now, is the time. There's more digital online learning than ever in history. So take the opportunity, get those badges, watch the online courses, and try and strengthen those hard skills, but really focus on the soft skills.
All right, going to leave it on that note. Hey, Amy, take care. Have a good week. And Amy Glaser, Senior VP of Adecco, joining us from Florida.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's kick things off with a tale of two different technology companies. One of them's really well known, one of the largest market cap companies around. The other private, but with some well-known investors.
Yeah, absolutely. We start with one that is a household name, Meta Platforms, which
I mean, nobody in households calls it Meta, right?
you don't. I don't know. I feel like I've
People who work there always call it Meta when I talk to them.
Oh, do they?
Here at Meta, yeah.
You're like, you mean Facebook?
Yeah, that's what I say to them.
All right.
Kurt knows what I'm talking about.
So Meta has definitely soared this year, folks. It's up about 65% year to date, making Mark Zuckerberg the world's second richest person for the first time, jumping ahead of Jeff Bezos as shares of Meta continue to climb. I wonder if these guys are like, did you see, like, I'm beating Jeff? Or does Jeff say, oh, man, Mark's ahead of me? I don't know. Do they do this?
Elon used to tweet about this. I don't know if he still does that.
All right, there's that.
Speaking of Elon, we got with us Bloomberg News technology reporter Kurt Wagner. He joins us from Denver. I say speaking of Elon because Kurt is the author of Battle for the Bird, Jack Dorsey, Elon Musk, and the $44 billion fight for Twitter's soul. Where I want to start with you, Kurt, is this new AI tool that can generate or edit videos based on a simple text prop. It's like kind of a worrying thing, I think, for a lot of people because of deepfakes. Explain what Movie Gen is at Meta Platforms.
Yeah, it's pretty nuts. It's this, as you said, you can take a text prompt, show me a video of, someone snowboarding on a mountain or whatever you could imagine. You can get as creative as you want. And it'll shoot out a video up to 16 seconds long right now. They look pretty good. The demos that Meta displayed or showed off to the press, like they look like legit, camera taken videos. And the idea is that it's, going to make it easier and more fun and more enjoyable for people to ultimately share this stuff onto their networks in the future. But as you point out, it's kind of terrifying too, right? Because you could also imagine that people are creating stuff, for the wrong reasons, or they're putting actual people into scenes that never happened. They're, creating scenes of destruction that never happened and maybe misleading people as to what's going on in the real world. So it's not available yet in Meta's apps, in part because they're still working through the safety and security things behind this, but it raises so many questions. Yeah. Cool tech, a lot of questions raised.
Yeah, not the only company that's working on this. OpenAI has Sora, also some concerns about what's going on there. I got to tell you, Kurt, on Reddit, I've seen some pretty concerning, and they're clearly labeled as deepfakes, but just sort of a display of what this type of technology can do. Like, different compilations of world leaders in situations that you would never, ever see them in.
Yep.
And I mean, my head is spinning here, just trying to understand what this technology is going to do when it's unleashed on the world.
Yeah, and I think that's the concern that everyone has here. To Meta's credit, I will say they've talked a lot about trying to push the industry toward watermarking this stuff, right? So
explain what that means.
Some type of, it's basically adding some type of visible label to it to let people know as the minute that they see it, well, this is, been generated with an AI algorithm and it's not necessarily real. But you could imagine bad actors are not going to be deterred by that. They're going to try and take that watermark off or figure out a way to hide it. So Meta's also talked about trying to put stuff basically like in the code base of these videos so that even though it might not be immediately visible to someone who's looking at it, you could, in theory, go back in and say, well, based on the underlying data of this video or this photo or this text, we can tell it was generated that way. we're not there yet, right? We're not, and certainly not at an industry standard. And I think that's the problem, is that even if Meta wants to do this, it doesn't really matter if OpenAI or Google or Microsoft or whoever doesn't want to do it. So there needs to be some type of industry cohesion here around labeling this stuff. And I don't think we're at that stage yet.
Hey, why did this come out during Meta Connect? I mean, they just had a big event. I'm just curious why you didn't get any kind of clues, or none of us did.
I was a bit surprised as well. I actually spoke with a couple of their AI leads last week. They kind of hinted at it, to be honest, but I didn't expect that it would come a week later, because I was figuring if they had it this close to ready, we would have seen it last week. The only thing I can think of is maybe, they wanted to make last week all about those glasses, the Orion AR glasses, right? And maybe save this as sort of a little surprise teaser afterwards. Who knows exactly why, but the fact that, they are basically building these products in tandem, that they're both at this stage, is something that I think a lot of people would have been surprised about even just 1 year ago.
Hey, Kurt, we're going to be, we're talking, our show got blown up a little bit because of the press conference.
Okay.
But we were going to talk about some parallels between Hollywood and the dock workers. And I thought of this question when I was doing research for that. And you have to, because when the Hollywood writers and the bigger union was striking last year, their concerns were about, among other things, AI being used in production. And when I read your story and see what can be done with AI, I'm wondering how freaked out Hollywood should be.
Yeah, I mean, on the one hand, very freaked out, right? In the same way that, those of us in the print journalism world are kind of freaked out when you can go to ChatGPT and it'll write you a news article that looks pretty good. At the same time, Meta is trying to get ahead of that. They're working with filmmakers. They haven't said which ones, but they claim they're working with filmmakers in Hollywood to try and get their feedback on this, to try and make sure that they feel that they're in the loop on how this technology is developed. You could imagine a scenario where maybe you have an idea for a movie and you could use this to, create a mock trailer, right? You could say, hey, here's my idea. I sort of made this mock trailer that sort of gets the point across, maybe try to use that to sell the idea or pitch the idea. Right. But then, you actually do the real work when it comes down to it. That's one scenario. I don't know if filmmakers would love that, but they're trying to bring them along, so they say, in this process.
Well, and we already did a story right here at Bloomberg about, with AI, dead celebrities are working again and making millions. And so you're taking their voices, their likeness, and they're being put into movies. So there's a lot going on. Kurt, thank you so much. Bloomberg News technology reporter Kurt Wagner.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, about 18 minutes to go until we wrap up the trading day and the trading week. We're seeing some buying here into the close in terms of the equity trade. Charlie just breaking down the numbers. I'm looking for the week overall. Looks like we might be a little change for the week overall here, but it's been an interesting one.
You know what is changed is our view of the labor market.
Yeah, in a big way, right?
Yeah, I think that's fair to say.
For the moment, even though we heard Austin Goolsbee of the Chicago Fed saying,
don't just one report, guys.
But as Michael McKee said, it wasn't like a mixed report. It was everything was upbeat and strong, or stronger than forecast in terms of strength. Yeah.
What does Jason Bottenfield have to say about this? He's partner and managing director at the boutique wealth management firm Park Cities Group out at Steward Partners. He joins us from Dallas, Texas. Is there a new investment strategy to be made after today's jobs report?
Yeah, thanks for having me, Carol and Tim. This report was a little bit surprising. We've been seeing some
a little bit.
It was pretty eye-opening. I think, coming into this, my picture was, don't fight the Fed. You're probably gonna run a little bit into the year end. Thing is that the picture from that standpoint hasn't changed for me, but I do think that the Fed has a little bit harder job here on deciphering data and what's going to happen. Because if you're a trader right now, this is good news. This is good data. As you guys were talking about earlier, is good news, bad news? What is it these days? I just think it's going to be a little bit harder for the Fed I think my stance is nice through the end of the year. Could be some trouble in 2025, and these numbers are going to make it harder.
What's harder for the Fed? The fight against inflation because of the strength in the labor market and growth continuing? What specifically?
Yeah, I think so. I make these analogies or what have you, but I think the Fed is kind of like Smokey the Bear. We've got some embers that have been laying there, on fire, burning, not necessarily on fire, but hot. And a little bit of wind could spike up inflation again, and they definitely don't want that. They made a 50 move there, but we're with everything strong. It's good news is good news for the short term in trading, but for the Fed, in their private consumption conversations, they want unemployment to be coming up. I know that they have the dual mandate, and what they say publicly, they can't really say that publicly because that would be an issue, but that was helping them make these decisions. Now it looks like, hey, what's happening with unemployment? What's happening with payroll? What's happening with jobs? It looks like some things, a little bit of wind here, and we could have another fire on inflation.
It's funny you say this. You're spot on with what some other folks are saying. Our own Shonali Bassick reporting just in the last 15 minutes that billionaire Stanley Druckenmiller believes that the Fed shouldn't have cut rates by 50 basis points. He told Shonali this morning that he's concerned about the central bank that boxing itself into a corner by guiding for even more rate cuts. Mark Rowan said earlier this week it's not clear that we needed to lower rates. And then Larry Summers earlier on Twitter X said that 50 basis points in September was a, quote, mistake.
Was it a mistake, Jason, in your view?
That's tough for me to say. I'm not an economist, but from the standpoint of what we're seeing with the numbers now, it looks like it could be. But I understand why the Fed did it. They're trying to get in front of something. They don't want, because what happens with unemployment is, even though they quote unquote, I say the opinion is that they would want that to happen, to tick up a little bit higher from where it is that if it slides too fast, it's tough for them to catch it because they do have that blunt tool with the rates. They don't have a lot of other mechanisms. So, they moved, I think, as a little bit of a catch up and a little bit of built in. But, we may see a zero cut. And so what that portends to the market is, could be some issues, and maybe it's not any issues, but, there's just a lot of things out there. So my playbook it didn't really get ripped up through the end of the year. It's just going to get harder for the Fed, and it's going to get harder for me to tell people, hey, this is good news in the short term, but bad news in the long term. That's kind of how I see it, and I think that maybe that's how the others are seeing it.
But you advise, obviously, your clients in terms of how to invest, and I'm just curious, are you saying get ready for a slowdown, for it to be more difficult and the investment environment more difficult? Are you saying, with the Fed now in a rate cutting cycle that may not be as aggressive as some have originally forecast, that risk on trade? That's what I'm curious.
Yeah. So that's a great question. And in my business, you commonly have people like me come on and say, hey, look, I'm a long-term investor, and stay invested. The question is real boots on the ground, is that if you're dealing with people that are in retirement and they need cash flow over the next 12 months, and they know what that cash flow is, you need to be generating that cash flow now. A lot of people just wait and generate as they go each month. So there's a stance that you take. Do I pull off of my long-term strategic allocations to equities? No, I feel like that this market, we usually rebalance every quarter. We didn't rebalance this quarter on our equities. We wanted them to keep running. I feel like that is going to happen, and it's continuing to happen here. But from that stance of what happens going forward, that's where we have to do a lot of the hard work on the financial planning side, is to say, hey, if you have expenses coming up in the 6 to 12 months, I want to generate that cash now. And even though the short-term rates and bonds are going to be going down, and I'm not going to make 5.25%, I may make 4 or 4.5 or maybe lower over that period. I want that cash outside of even the bond market or the equity market. And so that's essentially how we're managing it right now.
Where are you putting the cash? Are you putting it in money markets still, even though rates have come down?
Still putting it in government money markets right now on that cash that I know is going to have an expense in the next 6 to 8 months, right?
Like a tax liability or something of the like?
Yeah. So people that are retired, look, if they're spending X amount, they know what they're going to spend over the next 12 months. within reason. There's things that pop up, ACs go out or what have you. But, there's also, if you're not in retirement, there's people that know what they're spending. I'm going to buy a new car. I'm going to do this. I'm going to take a vacation for this much. That type of money needs to be outside of any kind of risk, because just like we're seeing today, I like intermediate bonds. They've been doing well, but they've backed up a little bit today, right? The 10-year spiking up, and that could rise up some more. But I do think ultimately the Fed at some point is going to be lowering rates. But right now, it's that stance of stay invested, stay with your picture. But if you need cash flow, use these opportunities where the market's high and get that cash off, because you just don't want to play that risk game. And a lot of people do it. And then what happens is that they defer doing things because they didn't pull the cash off when it was high, and then they just don't take that vacation. So that's a bad strategy as well.
All right, gonna run. Hey, Jason, thank you. Jason Bottenfield, he is Managing Director at Park Cities Group at Steward Partners, joining us from Dallas, Texas.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.